Hello and welcome to our presentation on mortgages today. My name is TC. I work at the M&T Bank right over by Acme over here in Mahwah. My coworker Angel will be joining us in just a few minutes. There we go. Many people buy a home for various reasons. It could be to raise a family, to have a permanent address, the whole many different reasons out there for people to start looking for a home. Whatever your reason may be, you'll probably need a mortgage to be able to help pay for it. Okay. Most people do not buy a home using only their funds. According to the National Association of Realtors, 86% of homes are purchased using a mortgage. Buying and owning a home is a dream for many people, and there are ways to achieve it while sticking to your budget. In this workshop, we will focus on different types of mortgages, common costs associated with mortgages, your financing options, and how to get started with the application process. Getting a mortgage doesn't have to be an anxiety-ridden process. Simply knowing more about mortgages can help. So let's get started. Okay. So first, we're going to define the term mortgage. A mortgage is a loan that you take out to purchase your property. If you want to buy a home that costs, say, $100,000 and you only have $10,000 to use towards the purchase, you'll have to go to a lender to obtain a mortgage of $90,000. While the total amount of the mortgage might be very high, you won't be paying it back all at once. Payments are spread out over many years and made monthly. Several costs are involved in borrowing the funds and repaying a mortgage. When you get a mortgage, you will need to make monthly payments that will include the principal or the original amount you borrowed, interest on the amount you borrowed, property taxes, and homeowners insurance, and if applicable, private mortgage insurance as well. All these costs are included in your single monthly mortgage payment, most of the time. So are there situations where people might use some of these same terms like principal and interest? Yeah, so if you're borrowing like student loans or on a car or applying for a credit card, those are some of the places you hear some of those other terms. So the principal is the original money you borrow. It needs to be paid back in full. If the bank lends you $90,000 and you pay back $50,000, you still owe $40,000 of principal. Banks earn a profit when they lend you money. They do this by charging you for the funds you borrow. That fee is called interest. The lender will determine an interest rate, which is a yearly percentage of the principal you owe. The higher the interest rate, the more you'll ultimately pay each month. A down payment, that's the money you use from your own funds towards the purchase of a home. If you have $10,000 in the bank to buy a home and a $10,000 house, you would make a $10,000 down payment and get a $90,000 mortgage. Different loan programs require different minimum down payment amounts. Regardless of the program you use, the down payment will generally be referred to as a percentage of the home cost and not a dollar amount. For example, your lender might tell you you need to make a 20% down payment. In the case of a $100,000 home, that would mean you need to make $20,000. If you buy a $150,000 house, you would need a down payment of $30,000. And then we have private mortgage insurance. If your down payment is less than 20% of the home selling price, your lender will require private mortgage insurance or PMI. PMI protects the lender if you're unable to pay for your mortgage, and it generally costs $30 to $70 per month for every $100,000 you borrow. Depending on the type of mortgage you have, you may be able to eliminate PMI payments once you made enough mortgage payments to have a 20% equity in your home. Next, we're going to talk about mortgage points or discount points. When a bank presents the interest rate to the borrower, it might offer the option of buying down the rate by paying a percentage of the loan amount to the bank up front. This fee is called points. The word point simply replaces the word percent. Your banker might tell you that the bank's current rate is 3%, but if you pay a quarter of a point, they can offer a rate of 2.75. If you are borrowing $100,000 a quarter of a point, which is the same as saying a quarter of a percent, would equal $250. You'll encounter several other costs when you buy a home. Some of these include an appraisal to ensure the value of your home is accurate, title insurance to guarantee the seller actually owns the home and that there aren't any outstanding liens, an attorney fee in some cases, especially here in New Jersey, and other bank-related fees. When you apply for a mortgage, your bank will provide an estimate of all these costs so you'll know exactly what to get. In the example on page 3 of the guide that we have up here, if you don't have one, I can hand one to you, sir. On page 3, there's an example there. It shows how to calculate for the down payment if you want. So how much you need for the percent. So if you have $100,000, you multiply that by 0.30 to get $30,000. And it shows the different math on how to help you out with that. There are many aspects to getting a mortgage. Knowing what to prepare for and planning ahead will make the process much smoother when you're ready to buy a home. Okay. So even if you're only thinking about buying a house, which many people are in that process right now, it's not too early to begin preparing for your mortgage. The more time you have to get yourself ready, the better off you'll be. Let's start by discussing budgeting. Do you guys know how to budget your money already? I'm hoping you do, right? Okay. Knowing how much you earn, spend, and save can help you figure out how much of a mortgage and down payment you can afford. Adjusting your spending and saving habits now, even if you're a few years away from homeownership, can put you in a better position to improve your credit score and get a mortgage with favorable terms. Okay. Creating a budget can give you a clearer picture of your finances. Whether you want to buy a house, plan a trip, or save for another goal, a budget is an important early step. You may not have all the information to fill in the worksheet right now correctly, but once you get home, you can start filling that out, and it'll help you figure out your budget that way. And as I mentioned before, you will need to prepare it to pay a lump sum for a down payment. So you'll start preparing your budget to save up that extra money each month. Here. Okay. So the steps for preparing for the mortgage here. Next, you'll have to get your credit score. Actually, I think I missed a spot there. Yes, okay. Next, you'll have to get your credit score, and having a better credit score will help you get a better rate on your mortgage. The lower the rate, the less you'll pay every month. You can find your credit score at myfico.com, vantagescore.com, mycreditreport.com. There's a whole bunch of different sources you can use to find that. If your credit score is poor, you can try to build that back up over time by paying your bills in time or going to your local bank and talking with them about different options to help you out. Next is collecting your documents. You need to keep at least 2 years' worth of the following records in case a lender wants to see them: your tax returns, W-2s, employment history, and bank statements. Okay, now we talk about calculating home affordability. You have to look at your budget and see how much money you have every month after paying your monthly debt. Then use a mortgage calculator to figure out how much of a payment you can afford to determine how much you would like to borrow. Remember, you'll also have to pay real estate taxes and homeowners insurance monthly too. Once you get that, you can start saving and start paying down your other debts so you can get your credit score back up. It's also good to research around for different mortgage companies and talk to different banks. A lot will have many different fees and different requirements that you need, and there's a little bit of variation in mortgage rates with them as well. And then you can go ahead and get pre-qualified. With M&T, it's as simple as going to our website. With other banks, I'm not sure how they work, but they're probably just as simple as well. Some lenders only offer pre-qualification, while others offer pre-approval. Work with whichever lender you choose to see what's required from you. In general, be prepared to give the lender proof of your annual income, proof of the value of your assets such as car, property, or investments, a record of your debt, such as any loans or credit card debt, and your credit history. So what is the difference between pre-qualification or pre-approval? In return for providing a lender with information on your income, assets, and debts, you'll get a letter stating the mortgage amount and interest rate the lender may be willing to offer you. This isn't an approval, nor are you obligated to work with that lender. It's just an estimate, and this process lets you find out about any problems you may have getting a mortgage so that you can address them. So now that you know the steps involved in preparing for a mortgage, let's talk about the different types of mortgages.
Hi everybody, I'm Angel. Thank you for coming here and listening to this presentation. I hope it's useful. TC did some of my work so far due to some baby circumstances. But anyway, let's go on. So making a budget and knowing how much you can afford are important steps, but you'll also need to know the types of mortgage options. Choosing the right mortgage depends on your income, credit, and how much money you have for a down payment. It also depends on how quickly you plan to fully pay off your mortgage and how long you plan to live in your home. When you make a payment on your mortgage, it will affect your loan in a few ways. With most mortgages, in the beginning, a larger portion of your payments will go towards the interest than the principal. So it makes sense. When you owe a big portion of your mortgage, your interest is very big. But at the end, when you have very little left on your mortgage, your interest payment is going to be just a small portion. As you pay down your mortgage over time, a larger portion of your monthly payments will go down towards your principal until the loan is paid off. And this is called amortization. Sometimes mortgages are, yes, amortization is AMORTIZATION. So it means to pay off your loan. It's a, so yeah. So sometimes what you can do is like on Excel, if you want to see how long it's going to take you to pay off loan, you can look for amortization schedules. So it's basically showing you how much you pay every month, and it shows you how much of your loan is getting paid off each month. Sometimes mortgages are structured. So, am I okay? Yeah. Okay. Sometimes mortgages are structured so your payments will go only towards the interest for a specific period of time before being applied to both principal and interest later on. Some mortgages have a fixed interest rate for the life of the loan, while others have adjustable rates.
If you get a fixed rate mortgage, your monthly principal and interest payments will remain the same for the life of the loan. That doesn't mean that your total monthly payment won't change. Remember, taxes and insurance are included in your mortgage, and those can fluctuate, causing your payment to change. For mortgage purposes, the word term refers to the number of years you're borrowing the money. If your mortgage has a 15-year term, you will be repaying the loan monthly for the next 15 years. In general, the shorter the term of a fixed-rate mortgage, the higher your monthly payment will be because you're repaying the loan in fewer months. However, shorter-term loans often have lower interest rates because they're less risky for lenders. Because of this, the amount you'll pay in interest over the life of a shorter loan could be considerably less. While several loan terms exist, the most common are 15 and 30-year mortgages. And you can see here the difference in how much interest you'll be paying after 15 years versus the 30 years. So it's less than half. If you get an adjustable rate mortgage or an ARM, the interest rate will be fixed for a short term at first, ranging from a month to several years.
Can you go back? Can you say that again?
Oh, yep,
Get a fixed rate? No.
adjustable rate.
Okay, thank you.
You're welcome. Yeah. If you get the adjustable rate mortgage or ARM, the interest rate will be fixed for a short term at first, ranging from a month to several years. And after that initial term ends, the rate automatically adjusts monthly, quarterly, yearly, or even less often than that, depending on how your loan is structured. Because of this, your monthly mortgage payment may vary over time. It can increase or decrease. One risk of ARMs is that the interest rate may suddenly increase so much that you can no longer afford your mortgage payment, which is something we've been seeing recently with the rates going up so high from the feds. If you get a biweekly payment mortgage, your rate will be a fixed rate like regular mortgages, but you'll make payments every 2 weeks. Because there are 52 weeks in a year, this works out to 26 payments, or one additional monthly payment per year than you'd make if you made 12 monthly payments. This can help you pay down your loan a lot quicker. If your lender offers a biweekly payment program, it may work with a third-party processing firm that will charge you fees to make biweekly payments. You can still make extra payments on your own outside of a formal program. You just need to indicate that to your bank when you're making those payments. Knowing the different types of mortgages and how they will affect your monthly payments is a good step towards securing a mortgage. Another important step is finding the right loan source. Now, let's learn about different types of lenders.
Okay. So by the way, if you have any questions at any time, you can stop us and we'll be happy to explain. Like what Tisha was saying about ARM mortgages, like, do you have any questions about that? Or, okay.
What's a good FICO score?
Say that again?
What's a good score that you need to get a loan?
So to get a mortgage,
800?
actually, your FICO score, I think it has to be somewhere around as low as
I've
Five-
seen
580?
people get accepted with as low as like 580.
580, yes.
But you're gonna be paying for that.
Mortgage rate then.
Yes.
Usually they're looking probably, I would say 680 and higher. But again, the lower your score, the higher your payment's gonna be.
So, to answer your question in more detail also, we consider anything above 750 to be excellent credit score. 750, 750,
78.
50,
50.
760.
750,
Oh, 75.
yes. It can go up to 850, but if you get past 750, everything
golden.
else is like gravy. You can also check your credit score once a year for free with the credit rating agencies. So you probably know is Experian, TransUnion, Equifax. Those are the three main agencies. And that's something that you can do, and you are encouraged to do that, because sometimes you could have a bad surprise, like somebody stole your information, and suddenly you had a loan that you never knew. So you can fix that right away instead of waiting 2-3 years and have your credit destroyed.
Can you qualify for a mortgage without using your credit score?
They will always run your credit score.
So we'll talk about how you can apply for a mortgage if your credit is not good or is not great. Okay, so, all right, so where do you get a mortgage, right? So there are different options. You may have seen advertisements for mortgage lenders on TV, in magazines and newspapers or online. You may have learned about lenders from friends or family, so you know there are lots of options. So have you applied for a loan in the past?
I'm just asking a question.
Yes. Yeah, 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 yeah.
I'll pass on that, I'm not, you know.
Okay, all right. So I have, so, people get loans for things
I
like,
have a question for you, though. Do you retain your mortgages or do you sell them?
uh,
Do you service the mortgage?
yeah, so we typically buy them from other lenders, that's what I have seen. So we are getting a lot of customers that were that's what I see in the branch. We're buying mortgages from other lenders. And sometimes we may sell them as well. But
We don't
what
have
I,
a statistic on that one, though.
but what I see, like, in my experience, is that we tend to buy mortgages. Okay, so there are things like personal loans, auto loans, student loans, business loans. So we'll start with the first two, banks and credit unions. Financial institutions such as banks and credit unions usually have mortgage loan options, MLOs, who can work with you, mortgage loan originators, sorry. Different banks and credit unions have different requirements and qualifications. Then we have savings and loan associations. They are also called thrifts. These financial institutions provide many of the same services as banks, but tend to place a stronger emphasis on residential lending. So they're like banks, but maybe organized like credit unions. So like banks, savings banks and loan associations can allow members to open accounts, make deposits, and obtain credit or debit cards. But unlike banks, however, savings and loan associations must use a majority of their funds for non-commercial mortgages. That means they must use their funds to support customers who want mortgages to buy homes. Okay, and then we have the difference between mortgage bankers and mortgage brokers. So you may work with one or the other when you get a mortgage. So a mortgage banker works for a bank or other financial institution that lends you the money for or originates your mortgage. After originating the mortgage, the lender may continue to service it or sell the loan, like you were pointing out, to another organization. A mortgage broker is an agent who brings together lenders and borrowers. Brokers don't make loans, rather they find a suitable lender for a borrower. The selected lender provides the mortgage and also pays a fee for the broker, to the broker for the services. A mortgage broker works with many financial institutions but charges a fee or takes a percentage of the loan as a commission. Financial institutions typically give out loans to individuals with good credit scores and may have restrictions on interest rates, down payments options, and other fees. If you have poor credit or if you qualify as a veteran, other options are available to you.
So in addition to private lenders such as banks and credit unions, there are federal lenders such as the federal, state, and local governments can also lend money for mortgages. The Federal Housing Administration, which is part of the U.S. Department of Housing and Urban Development, approves lenders and loan products. HUD's main goal is to make sure that affordable housing options exist for anyone who wants to rent or buy a home. To achieve that goal, HUD runs loan programs through the FHA, Federal Housing Administration, to help individuals who may not qualify for mortgages. You can go to hud.gov to find where you can find certified lenders for that. And most states have housing finance agencies to provide affordable loans and housing options to their residents. The National Council of State Housing Agencies oversees the state organizations. If you belong to a special group such as veterans or first-time homebuyers, or if your income is below a stated amount or within a particular range, you may be able to take advantage of a lot of these special programs. You can contact the state and local agencies online. So New Jersey has one it's right on the front of the state's website. If you're looking for New York or Pennsylvania, it's also right there on the front websites. Okay, so let's take a closer look at some of these federal and other government programs.
Okay, so we're going to review some of the different resources available to you that might be of help, and each of them have different requirements and restrictions. So in the first place, we have the Federal Housing Administration, or FHA, insured loans. This can help you insure your loan so you're able to get a better deal through a private lender, such as a bank, credit union, or mortgage company. If you don't have a good, a long enough credit history, so that's more or less, I think, in line with what you were asking before. Or, for example, if you have recently immigrated to this country, or you have recently received your first credit card, you may still be able to apply for an FHA loan. FHA loans can be more expensive than conventional loans, so you should speak with a loan officer at your financial institution to learn more about options and total cost. Then we have the Federal National Mortgage Association, or Fannie Mae, and the Federal Home Loan Mortgage Corporation, Freddie Mac loans. Fannie Mae and Freddie Mac both offer many loan programs, some of which are targeted to people who are first-time home buyers, are low to moderate income buyers, belong to certain professions such as teachers, firefighters, law enforcement officers, and healthcare workers, or need to include, and also might need people who might need to include other people's income to qualify for a loan. Your lender will find the Fannie Mae and Freddie Mac programs that work best for your scenario. We also have the Department of Veterans Affairs, VA, insured loans. This is for eligible veterans, service members, and surviving spouses. The VA will guarantee a portion of a loan from a private lender. The type of program that you qualify for can depend on the length and status of your service, and you'll need a certificate of eligibility, which you can get online via mail or even through the lender. And we also have the United States Department of Agriculture, USDA, housing service. That's for those looking to buy homes in rural areas. The USDA offers several types of loan assistance, both direct loans and guaranteed loan programs. Loans such as the Section 502 direct loan program assist those who may have a difficult time qualifying for a traditional loan. For a direct loan from this program, your income must be less than a specified amount, which varies depending on where you live and how many people live with you. The property must be your primary residence, and you must be a good citizen or eligible non-citizen. And then for down payment assistance, many government programs have qualified borrowers by either lending or granting them some or all the money they need for a down payment. So you can browse through some of the grant programs in your state by visiting www.fha.com or www.hud.gov.states. Okay, so once you have decided to purchase a home, let's go through what you should do.
Okay. So, whether you're ready to get a mortgage or just thinking about getting one, you can take some steps to prepare to meet with a lender and find a mortgage that suits you. First, you can follow these steps. Number one, find a credit score. You can do that from myfico.com, vantagescore.com, or going to any of the major credit score companies and finding it that way. And as you were asking before, what is considered a good score? People with a good credit score generally get better interest rates and repayment plans. Different bureaus have different ranges for a good credit score. According to FICO, anyone with a credit score above 670, has a good to exceptional credit, and that's considered good for mortgage purchases. If you have,
Ask a question.
yeah, go ahead.
When you have multiple buyers who go into contract,
Mhm.
how do you determine the average, or how do you determine the FICO score when you're giving them, that instant when you're giving multiple, people who are in debt on the loan,
Mhm.
determining their qualification?
So the purchase of the house side of it and getting the pre-approval for the mortgage are two separate things. The home that you're buying, the person who already lives there isn't going to know what your income is or anything like that. They're just going to see what's on the paperwork in front of them.
No, but that's not my question. The question is, how do you determine the eligibility of a group of people that are purchasing? So let's say you have a 5-bedroom home, as an example.
Oh, so you're talking like if a husband and wife are going together on it, right? Okay. Go ahead and finish.
Family,
Yeah, yes.
other relatives, then they want to purchase together, pool their money,
Okay.
be able to purchase an $800,000
Yes.
house in Bergen County.
So they go with the
That's
person?
reality.
Yeah. So they go with the person who has the lowest credit score on that, and that's what they base it off of. Yes, because I had that same exact question when I was getting my mortgage as well. So what if you do have a credit score under 670? If it's not great, don't worry. You can begin to take steps to improve your credit. First and foremost, it's pay all bills and debts on time and in full. This is the quickest way to improve your credit. If you have maxed out credit cards or ones that are towards the max, try to keep those below 30% usage. If you see any errors on your credit report, dispute them or report fraud with the credit reporting agencies, Equifax, Experian, and TransUnion. Contact the company that reported the incorrect or fraudulent information to the reporting agencies. And there's credit repair organizations out there as well that can help you bring up your credit score. But there are some scams out there too, so just be wary and do research. Next step is save for a down payment. The general rule of thumb is to aim to save 20% of the purchase price. Remember, the larger your down payment, the better your interest rate should be. Step 3 is to start comparing costs. Compare offers from different mortgage lenders, including the fees, different insurance, interest rates, and down payment requirements. Find lenders with whom you work well. Make sure they'll be willing to answer all of your questions and not just brush off anything that you have. If they don't want to clarify anything with you at that moment, don't work with them. A good lender will not only find you a loan with a favorable interest rate, but also one that you can comfortably afford to make payments on. And you have to just watch out for brokers or lenders who might want to offer you loans with interest rates that will increase more than you are comfortable with over time. If you do choose an adjustable rate mortgage, you should fully understand when and how your interest rate will change. So you know how to prepare yourself for a mortgage, but how do you go about applying for it and securing a mortgage? Angel will get us started on that one.
All right, so at this point, you've progressed to where you can contact lenders to get your mortgage started. You'll receive mortgage pre-approvals, narrow down your list of potential lenders, and have your eye on homes within your budget. It's time to proceed to the mortgage application process. The lenders you're considering will provide loan estimates. If you like an estimate in a lender, notify the lender of your intent to proceed with the loan application. You must do this within 10 business days of receiving a loan estimate. You may be charged an application fee at this point. After that, the lender will need to see your financial documents and confirm other financial information before finalizing your loan and its terms. Next, you will begin the process of settlement with the lender and prepare to receive the loan. So we look at this each of these steps in greater detail now. Okay. So the pre-approval or pre-qualification process can be quick. At this stage, lenders want to learn about your personal financial situation and credit history. They will use the information to decide what kind of loan you can get and how much you can borrow. So if you, on your guide, if you go to page 6, there is a pre-approval checklist. Page 7, you can see my total income, and page 8, my total assets and my total debts. So it's something that's good to get familiarized with, in case you want to learn more about your financial situation. So what kind of questions might lenders ask during pre-qualification? Let's find out. They will most likely ask you for the following. So one is, what is your annual income? So your income is something that you can show with your salary, money earned through tips, money earned from self-employment, money earned through investments, Social Security benefits, disability compensation, unemployment compensation, pension, alimony and child support payments, money from renting property, money earned overseas or abroad. So there is basically a long list of items that can qualify as income. Your income does not include loans, supplemental Social Security income, gifts from friends or family members, or veteran disability payments. Okay, so next we will look at your assets. So what qualifies as an asset? It's basically money in your banking accounts, your vehicles, electronic appliances, valuables, so jewelry, fine art, etc., and other properties such as homes, land. What are your total savings? Total savings includes things like your checking accounts, savings accounts, certificates of deposits or CDs, and savings bonds. And what are your total debts? So basically loans and credit card debt. And then of course there is the credit score. They also look at your credit score. I think we have discussed this, how having a good credit score works in your favor, and having low credit score or no credit score is going to make things harder for you. So remember, there is pre-approval or pre-qualification. It doesn't mean that you are approved for the loan. So, but it's a good idea to get. It's a good way to get an idea about what you can afford, and to discover any potential problems early. So let's see what the loan estimate and application looks like.
Nope, still same slide, but I'll go back.
Okay, no, sorry. Yeah, so the next step is when you receive loan estimates and choose a loan to apply for. Once you've narrowed down your choice of lenders and potential houses, you need to receive loan estimates from each lender you're considering, and you need to provide this information: your name, income, Social Security number, address of the home you're buying or you would like to buy, the home's sale price, the amount you want to borrow. The lenders will then decide on the mortgage amount and terms you can get, and will provide you with loan estimates, which spell out the loan amount, interest rate, monthly mortgage payment, lender-related fees, and other information. We'll go over a loan estimate in greater detail shortly. So what type of documents do you think a lender would need to see to verify or confirm your financial situation? So things like pay stubs, tax returns, account statements, or loan agreements. Okay. So there is also some additional information on page 9, if you want to review it later. So you don't have to know all of this right now, but it's good to go over some checklist items so you're prepared for the future. The loan estimate process can take longer than the pre-approval process. This is because the lenders need to look at each of the documents and make sure that they provide them with a clear picture of your finances. You definitely want to shop around for your loan. Some lenders will offer better terms and lower fees than others. Loan estimates are very thorough and will help you compare the cost of choosing one lender over the other.
All right. So once a lender or lenders present you with the terms and amount of your loan, you will need to evaluate whether the offer or offers are good for you and which one to choose. To help you better understand loan terms, lenders are required by law to give you information about the key features such as points, costs, and risks of the mortgage. Within 3 days of applying for a mortgage, a lender must provide you with a loan estimate to help clarify costs. As you can see by this slide here, you need to consider the upfront costs, monthly mortgage payments, and total amount you'll pay over the life of the loan. And there's a review sample on page 10 to 12 of the participant guide that I handed out. You guys can look over that. Pre-qualification and pre-approval are processes that give you more information about the loans you might qualify for. Once you apply for the mortgage, you receive similar information in the form of a loan estimate. You usually have about 10 business days to decide whether or not to accept a loan estimate. If you choose one of the estimates, express your intent to proceed with that lender. Read through your loan estimates carefully. Don't hesitate to ask lenders any questions you may have, correct any errors, and even negotiate some of the offered terms. Does anybody have any questions so far? Because I know this can be a little in-depth here. So, now that you have a good idea of how the mortgage process works, you're in a better position to plan ahead, research your options, and make the best choice for your budget. So there are a lot of things that affect the total cost of your mortgage and what you pay each month. Interest rates, fees, your down payment, the loan term, and more. Depending on each lender, there's a whole bunch of different things. They all shape how much it will cost you to buy a home. Understanding how the home buying process works and researching all the financing options available to you are critical steps on the journey towards homeownership. Do you guys have any questions about anything we discussed today? Yes.
I have a question. So when you're shopping around for a loan, do they check your credit score? And will that hurt you if you go around to different ones?
So yes, it does hit your credit score, but if you get it all within, say, a month period of time or a short period of time, they go, oh, okay, this person's just shopping for the best rate. So it's going to count as one hit for all of them instead of 5 different hits for 5 different lenders.
So when you're shopping for a lender or a loan, make sure you do it within a month span, so this way it only
Yes.
hits you once
Mhm.
instead of multiple.
Yeah,
Okay, thank you.
you're very welcome. Any other questions? All right. Well, thank you guys for coming today. I appreciate your patience waiting for us to get started here. And if you have any questions, Angela and I both have our business cards on the table here. And if you want, we'd have 2 of you guys give your contact info. You can give your email address or phone number, and we can have one of our mortgage reps reach out to you, who can go into a lot more detail about the whole mortgage process.
Wait, can I ask one question? What is M&T's approach to debtors with the Internal Revenue Service? You require them to pay off the balance they owe first, or just have an installment agreement in place that they're paying the monthly payment?
That one I don't have an answer for, unfortunately. But I can reach out to my mortgage rep and ask her that question.
It's good for you to know.
Yeah, that is a good question, yeah. Have a good day, guys. If you want, you can put your contact information down here, and I can,
I'm asking you,
okay.
you